Hello guys, welcome to Practical IFRS YouTube channel. The purpose of this channel is to make you acquainted with the practical sides of IFRS standards. And we will solve a lot of practical questions relating to the IFRS standards. We will be starting with IFRS 9 financial instruments, which as you know is considered to be one of the most challenging standards of IFRS. The question deals with the derecognition of financial liabilities and it involves some challenging computations and calculations. Let's get started with the question first. A 0% 10-year $200,000 value bond is dated and issued on the first day of 2016 at $98 and the interest is payable semi-annually. Associated bond issue costs are $14,000. 4 years later, namely on the first day of 2020, the entire bond issue is repurchased by the company at $102 per $100 face value, and the bond is retired. Amortization is calculated based on the straight line method, and we are asked to calculate gain or loss on the repurchase. At first sight, the question seems to be challenging, but don't you worry guys, because we will be taking practical steps in order to solve the question and make it very straightforward for you all. Now let's go to the answer of this question. According to your question, in 2016 the bond was issued at $98, so at a discount of 2%, and in 4 years it has been repurchased at $102. At the date of issue, the terms to maturity was 10 years. Issue costs amounted to $14,000. It was zero coupon bond. Total par value was $200,000, namely 2,000 bonds were issued. The purchase price at $102. It was repurchased $2 more expensive than its par value. We are required to calculate either gain or loss arising from the repurchase of the bond. So in order to arrive at that loss or gain amount, we need first to calculate the reacquisition price, because the question says that after 4 years the bond was repurchased at $102 per 100 par value. So it is 2% more expensive. That means in total reacquisition price was $204,000. But there are a few steps and calculations that we need to carry out in order to arrive at the final figure required. That is the net carrying amount that we are searching for. Okay, so we are searching for net carrying amount. Face value, which is par value, should be calculated first. Actually, it is given here, $200,000. Then it is, I have already mentioned that the bond has been issued at $98 per par value, 2% discount, and that discount should be spread over the whole life of the bond, which is 10 years. However, 4 years pass. That means out of 10 years, the amount attributable to 4 years of past time should be consumed, and the remaining 6-year part is not consumed yet. So unamortized discount need to be calculated here. So 2% of $200,000, okay, 2% multiply by 6 out of 10. Why 6? Because there are 6 years remaining. We consumed up 4 years of amount, but the remaining amount is unamortized. So that means the unamortized amount, I should show it as a negative figure. Unamortized discount amount is $2,400. The same issue, the same treatment should be applied to issue costs. Here we should calculate the unamortized issue costs, because 14,000 of issue costs is to be spread over the whole life of the bond, which is 10 years, but 4 years past, 6 years are remaining. Again, the same principle. Here we just multiply issue cost by 6 divided by 10. Okay, it is like straight line method amortization. Okay, so in total the unamortized amounts are 2,400 and 8,400, 10,000, $800. The remaining carrying amount is just sum of these three figures, which is $189,200. This is net carrying amount. Okay, and the difference between these two, net carrying amount minus reacquisition price, so it shows that, let me do it here because I'll name the line. It shows that we have paid 14,800 more than its net carrying amount. That means it is a loss because we overpaid the bond while repurchasing it. Okay, loss arising from repurchase of bond. That is it, and its final step here. I think it should be straightforward to you all. If not, please ask me in forums. I'll answer and reply on time. Thank you for your attention, guys.